You look at a marina, and the business model seems obvious. Boats need somewhere to live. You own the water, or at least the right to use it, and you rent out little rectangles of it by the foot. No inventory, no manufacturing, no customers walking out with your product in a bag. Just docks, cleats, and a waiting list. It looks like the closest thing to a passive income fantasy that real estate has to offer. That picture is not wrong. It's just incomplete in a way that matters enormously. A marina is not primarily a rental business. It's a real estate business wearing a rental business as a costume, sitting on top of infrastructure that is brutally expensive to build, nearly impossible to permit again once it exists, and increasingly at war with the ocean itself. Understanding how that gap between appearance and reality works explains why the marina industry has quietly become one of the most aggressively consolidated sectors in American leisure, with a $5.5 billion private equity buyout, followed a year later by that same buyer purchasing one of the country's largest boat dealerships outright. Start with the part that actually makes a marina valuable, because it isn't the docks. A marina needs three things that almost nowhere else has all at once: deep water close to shore, protection from open ocean swell, and legal access to that water that a government will actually let you build on. That combination is not something a developer can go create somewhere else if the price gets too high. There is no vacant lot 2 miles inland that becomes a deep water marina if you're willing to pay enough for it. The waterfront frontage with the right depth, the right shelter, and the right permits was mostly claimed decades ago. And in most U.S. coastal markets, regulators are not handing out new dredging and construction permits for greenfield marinas the way they once did. Wetlands protections, environmental review, and Army Corps of Engineers permitting can turn a new marina project into a process measured in years, not months. That scarcity is the entire foundation of the business. When an investor buys a marina, they are not really buying a dockage operation. They are buying a monopoly position on a specific stretch of coastline that cannot be replicated by a competitor no matter how much capital that competitor has. That's the kind of asset infrastructure investors, the same category of firm that buys airports, toll roads, and data centers, get excited about, because its value doesn't depend on outcompeting anyone. It depends on the fact that no one else is legally allowed to build the same thing next door. So if the land is the real prize, why do marinas still talk endlessly about slip revenue, occupancy rates, and dockage fees? Because that's where the confusion starts, and where a lot of buyers get the valuation wrong. Picture a mid-sized marina with around 250 slips, average boat length in the high 20s of feet, charging roughly $400 per foot per year, running at 92% occupancy. That combination can produce something in the neighborhood of $2.6 million a year in slip revenue alone, and slip revenue tends to run at a healthy gross margin, often north of 70%, once you strip out dockmaster staffing, routine maintenance, and insurance. On paper, that looks like a clean, high-margin cash machine. Here's the complication. A marina that's 92% full sounds like a wildly successful business. It can also be a business that has quietly boxed itself out of its own upside. Boat owners in coastal markets are sticky. Moving a 40-foot boat to a new marina is expensive and disruptive, so long-tenured slipholders often stay for years, sometimes under older lease terms that were never aggressively repriced to match what a new customer would pay today. Some marinas even sell slips outright as dockominiums, deeded or long-leased ownership of a piece of water, similar to a condo, which locks in that revenue at a price set years earlier and hands control of that unit to someone who isn't a tenant the owner can simply raise rates on. A marina can be full and still be earning well below what the same waterfront could generate if every slip were repriced to the current market. Full does not always mean profitable. It can mean the opposite, a business quietly leaving money in the water because turnover is too rare to correct it. This is where the real profit engine reveals itself, and it usually isn't the slips at all. Modern marina operators increasingly make their real margin from what happens around the boat, not from the water it floats in. Dry stack storage, steel racks that hold boats out of the water inside a covered structure, with a forklift launching them on request, is one of the fastest growing formats in the industry, and it explains why. A dry stack facility can pack somewhere between 300 and 500 boats into the same footprint that would otherwise hold 50 to 80 wet slips. That's not a modest efficiency gain. That's 4 to 6 times the revenue density on identical land, in a format that runs 20 to 30% cheaper per foot for the customer while still being highly profitable for the operator, because the operator isn't paying to maintain floating docks, pilings, and underwater infrastructure that saltwater is constantly trying to destroy. Then there's the service side, and this is the part almost nobody outside the industry thinks about. A marina's slip holders and dry stack customers are, functionally, a captive audience. Their boat is already sitting on the property. When something needs fixing, when the bottom needs painting, when the engine needs winterizing, the marina's own service department is standing right there. And switching to a competitor means trailering the boat somewhere else, a hassle most owners simply won't take on. That captivity is exactly what makes repair and service labor one of the highest margin lines a marina runs, often outperforming the glamorous parts of the business. Fuel sales, by contrast, look impressive on a revenue line. A marina can move $1 to $3 million a year in gas and diesel, but they run painfully thin, often only 10 to 20% gross margin, because fuel is a commodity the customer can price check anywhere. The biggest number on the page is not the most valuable number on the page. That gap between what looks big and what actually pays the bills is the first hint of a pattern that shows up again and again in this industry. Now for the part of the business almost no one factors in until it's too late, the part that has been quietly reshaping who is even allowed to own a marina anymore. A marina's most expensive asset, its docks, floating or fixed, sits directly in the path of the exact weather events that have been intensifying across U.S. coastlines. A hurricane doesn't just inconvenience a marina. It can physically destroy the infrastructure that generates the revenue in a single afternoon, while the debt used to build that infrastructure keeps accruing regardless. During storms like Irma and Ian, the difference between formats told the whole story. Many dry stack facilities in Florida came through with only minor damage, while nearby wet slip marinas saw boats driven into pilings, floating docks torn loose, and in some cases, total losses. That single data point explains a lot about why the industry has been racing to build more dry stack capacity. It isn't just about efficiency, it's about survivability. But even dry stack doesn't remove the deepest structural risk, which is insurance. Coastal marina insurance has been getting both more expensive and harder to obtain at all, and that single line item can quietly determine whether a marina survives, gets sold, or gets abandoned. A marina's operator liability coverage is typically priced against total revenue and payroll, so as costs rise, they don't just eat into profit, they can make the entire operating model fragile in a way slip revenue alone can't fix. Follow that thread and you get a genuine chain reaction. Rising storm frequency pushes insurers to raise premiums or exit certain coastal markets entirely, which raises the cost of simply keeping a marina open, which independent, undercapitalized owners increasingly can't absorb, which forces a sale, which large, well-capitalized buyers are only too willing to make. The storms aren't just a maintenance problem, they're an ownership filter, quietly sorting the industry into whoever has deep enough pockets to insure against or self-insure through the next one. That filter is exactly what's been playing out in public, in real time, and it's the case study that shows how all of this actually connects. Safe Harbor Marinas grew into the largest marina and superyacht servicing network in the United States. Well over 100 properties across the U.S. and Puerto Rico, spanning everything from working-class wet slips to superyacht service yards capable of handling vessels well over 400 feet long. For 5 years, it was owned by Sun Communities, a real estate investment trust whose core business is actually manufactured housing and RV communities. Marinas were a sidebed, a diversification play into another form of scarce, sticky real estate. In February 2025, Sun Communities agreed to sell the entire Safe Harbor platform to Blackstone's infrastructure arm for $5.65 billion. Blackstone's own explanation for the deal wasn't about boats at all. It was about long-term structural tailwinds, population growth into coastal cities, and leisure travel that keeps expanding, sitting on top of a supply of usable waterfront that isn't expanding at all. That's the land thesis, stated almost word for word by the buyer itself. Here's where the story turns from a single acquisition into something closer to a strategy. In August 2026, just over a year after Blackstone's deal closed, Safe Harbor itself became the buyer, agreeing to acquire MarineMax, one of the largest boat dealerships and superyacht service companies in the country, for roughly $1.5 billion at $53 a share, a price that came in at nearly double what MarineMax's stock had been trading at only weeks earlier. Think about what that actually accomplishes. Safe Harbor already owned the water the boats live in and the racks they're stored on. Now the same company owns a major channel selling the boats in the first place. That's not a marina company anymore. That's a vertically integrated pipeline running from the boat show floor through the sail into the slip, through years of storage and service fees, and potentially back out again when that boat gets traded in for a bigger one. The customer never has to leave the ecosystem. Neither does their money. What that case study proves is the counterintuitive part in full color. The visible product, a rented slip, a stored boat, a boat sale, was never the actual point. The point was building a closed loop around a customer who, once they own a boat, is genuinely difficult to extract from that loop, layered on top of coastal land that legally cannot be duplicated by a competitor, no matter how much capital they raise. So who actually loses in a world that consolidates this way? Mostly the independent operator, the family that's owned 40 wet slips on the same stretch of river for 2 generations. They don't have Blackstone's balance sheet to absorb a bad hurricane season, or to self-insure when a carrier pulls out of their county. When the storm comes, or when the insurance renewal letter arrives with a number that doesn't work anymore, their realistic options shrink to 2. Sell to a consolidator with the capital to weather it, or exit the business altogether. That's not a hypothetical. It's the exact mechanism that has been steadily concentrating marina ownership into a small number of very well-funded platforms over the past several years. Compare the outcomes honestly, because the range here is wide. In the best case, a marina sits on genuinely scarce, well-protected waterfront, layers in dry stack and service revenue on top of dockage, gets acquired or backed by a capital-rich operator that can insure through the bad years, and becomes exactly the kind of durable, monopoly-like cash generator that infrastructure investors chase. In the realistic successful case, it's a solid, moderately profitable business that survives storms, slowly repriced legacy slips, and margin-thin fuel sales because the land under it never stops appreciating, even when the operating numbers are mediocre. In the realistic negative case, an independent owner gets caught between rising insurance costs and a storm that outpaces what any policy was willing to cover, and ends up selling under pressure, at a price set by the buyer's timeline, not theirs. In the failure case, the docks come down in a single storm. The permits to rebuild take years to clear. The debt keeps compounding with no revenue coming in to service it, and the passive income fantasy turns into the exact opposite, an illiquid, uninsurable liability sitting on some of the most desirable real estate in the country, owned by someone who can't afford to fix it and can't easily sell it either. So, go back to the picture you started with. Rent out water by the foot, collect checks, repeat. That was never really what this business is. A marina is a claim on a piece of coastline that the world cannot make more of, dressed up as a rental operation so the economics look simpler than they are. The slips are the visible transaction. The land, the permits, the dry stack density, the captive service revenue, and, increasingly, the insurance math are the real business underneath it. That's why the money in this industry has stopped flowing toward whoever can build the nicest dock and started flowing toward whoever can survive the next storm and own every step the boat owner takes afterward.